If you took a broke family and a rich family and swapped their bank accounts overnight, what do you think would happen in 5 years? Most of us have this comforting mental image. We imagine the broke family would finally be set for life, and the rich family would struggle. But here is the truth that the financial industry doesn't advertise. Statistically, within a few years, the money would likely return to its original owners. Why? Because wealth isn't a number in a bank account. It is a habit. It is a specific way of viewing the world that separates the producers from the consumers. Today, we're going to tear down the facade of modern wealth. We aren't talking about skipping lattes or clipping coupons. We are going to look at the mechanical, mathematical difference in how rich and broke families treat a single dollar bill. Hi, I'm Leo. Welcome back to the Capital Mist. We are taught from a young age to go to school, get a job, and save money. It sounds simple, right? But if that formula worked, why are nearly 60% of Americans living paycheck to paycheck, including those making six figures? The system is rigged to maximize their profit, not yours. They count on the fact that you are too busy working to understand the flow of capital. But knowing mechanics is the first step to opting out of the bad deal. In this video, we are going to break down the single most critical habit that separates the wealthy from the broke. We will look at the numbers, because this is where the disparity becomes shocking. We'll cover why saving is actually losing, how the rich use debt as a tool while the poor use it as a shackle, and finally, the exact system you can use to flip the switch. If you want to stop paddling upstream and let the current of money work for you, you need to understand this. Let's start with a fundamental shift in perspective. Most people believe their problem is income. They think, if I just made $10,000 more a year, I'd be rich. But here is the kicker. Without the right habit, more money just accelerates the problem. This is known as Parkinson's Law. Expenses will always rise to meet income. When a broke-minded family gets a raise, what happens? They don't buy assets. They buy liabilities that look like success. A nicer car, a bigger house, a subscription service they don't use. Do you see what is happening? They are increasing their cash flow, yes, but they are also increasing their burn rate. They are effectively running on a treadmill that just sped up. The banking industry loves this. They don't advertise that they want you in debt, but they do. When you buy that car on credit, you are effectively paying a tax to the bank for the privilege of looking wealthy. Let's walk through a simplified example. You buy a $30,000 car. You finance it. Over 5 years with interest, you might pay $35,000 or $40,000. But the moment you drove it off the lot, it dropped in value. 5 years later, that car is worth $10,000. You paid $40,000 for an asset worth $10,000. That is a negative 75% return on investment. Rich families look at that math and run the other way. Broke families look at the monthly payment and ask, can I afford this right now? This is the trap. The broke habit is asking, what can I buy with this money? The rich habit is asking, how can this money buy me more money? It sounds subtle, but over a lifetime, this one question creates a canyon of wealth inequality. You are effectively working for the bank, for the car company, and for the taxman. You are the conduit for money, not the container. Now, let's look at the other side of the coin, the habit that builds dynasties. Rich families focus on one thing, net worth, not net income. They understand that income is taxed the highest, and it requires your time, your most finite resource, to generate. So what do? They practice the pay-yourself-first principle, but not in the way you might think. They don't just put money in a savings account. We've talked about this before. If you leave your money in a standard savings account, you are losing money. Inflation is eating it alive. It is lazy money. The rich habit is to immediately convert cash, which is a depreciating asset, into something that appreciates or produces cash flow. Stocks, real estate, businesses. Think about the math on that. If you invest $1,000 and it earns a 7% return, that money effectively worked for you. It generated $70 without you waking up, commuting, or dealing with a boss. Now, $70 doesn't sound like much. But wait, there's more. That $70 now starts working for you too. This is the compound effect. Let's look at a scenario. Family A earns $100,000. They spend $100,000 on lifestyle. At the end of the year, they have zero. Family B earns $100,000. They live on $80,000. They invest $20,000. In year 1, the difference is small. But in year 10, Family A is still working just as hard to maintain their lifestyle. Family B has a portfolio that is now generating its own income. Eventually, the income from their assets exceeds their expenses. That is the definition of freedom. The banking industry doesn't want you to know this. They want your money sitting in their vault, which we know is mostly empty, so they can lend it out to Family A at 20% interest. Do you see the cycle? Family B, the rich, effectively owns the debt of Family A, the broke. The rich are the bank. The poor are the customers. This brings us to the most misunderstood concept in finance: debt. We are often told debt is bad. And for 90% of the population, that is absolutely true. Consumer debt is a cancer on your wealth. It is borrowing from your future self to pay for a present desire. But here is where the rich operate differently. They use debt as a tool. They call it leverage. Let's say a wealthy individual buys a rental property. They put 20% down and borrow the rest from the bank. The tenant pays the mortgage. The tax code gives them deductions for depreciation and interest, and the property appreciates in value. They are using the bank's money to get rich. They are using the bank's lazy money to build their asset column. Let's compare this to the broke family. They use a credit card to buy a large TV. The TV produces no income. It loses value instantly, and they pay the bank 20% interest for the privilege. Same tool, debt. Two completely different outcomes. One is using debt to acquire assets. The other is using debt to acquire liabilities. It is effectively predatory lending disguised as a service when offered to the financially illiterate. But for the financially literate, it's a force multiplier. If you take nothing else from this video, remember this rule. Never use debt to buy something that doesn't put money in your pocket. If you are using a credit card and not paying it off in full every month, you are volunteering to be a victim of the system. You are effectively working hours of your life just to pay interest to a corporation that adds zero value to your life. Let me know in the comments, what is the highest interest rate you've ever seen on a credit card offer? I've seen some as high as 29%. That is highway robbery. There is one more layer to this habit. It's the time horizon. Broke families think in terms of Friday to Friday. How do I survive this week? Or how do I enjoy this weekend? Middle-class families think in terms of months or years. How do I pay for this car? Or when is my next vacation? Rich families think in terms of decades and generations. They are willing to live like others won't today, so they can live like others can't tomorrow. This is delayed gratification. When you get that paycheck, you have a choice. You can eat the seed corn or you can plant it. Eating it tastes good right now. Buying that new gadget feels good for about 48 hours. This is the dopamine hit consumerism is designed to give you. Companies spend billions on marketing to trigger that impulse. But planting the seed? That's boring. Watching an index fund grow by 8% a year is like watching paint dry. It's not sexy. It doesn't get likes on Instagram. But here is the truth. Boring makes you rich. Exciting keeps you broke. The rich habit is falling in love with the process of building, not the act of spending. It's finding satisfaction in seeing your dividends get reinvested, seeing that snowball get slightly bigger. If you can extend your time horizon, if you can stop thinking about what you want now and start thinking about what you want most, you win. The math guarantees it. So, how do we break the cycle? How do we move from the broke habit to the rich habit? It starts with an audit. Tonight, look at your last 3 months of spending. Not what you think you spent, but what you actually spent. Identify every dollar that went to a liability, something that loses value or takes money out of your pocket. Then, set up an automated system. Before you pay your rent, before you buy groceries, before you pay Netflix, a portion of your income must go to buying assets. Even if it's just $50, you have to build the muscle. You have to prove to yourself that you are an owner of capital, not just a user of it. The system is designed to keep you broke. It's designed to keep you working until you're 65, paying interest to banks and buying things you don't need. But you have the power to opt out. It requires discipline. It requires saying no to the short term so you can say yes to the long term. Don't let your money be lazy. Make it work for you. Because if you don't, you will work for it for the rest of your life. If you found this breakdown helpful, hit that like button. It helps the algorithm show this truth to more savers who need to hear it. Thanks for watching, and I'll see you in the next video.